Listen, Nebius Group just dropped their Q1 2026 report, and the numbers are absolutely insane. We're talking 684% revenue growth. In this explainer, we're diving deep into the genius strategy behind that massive surge. I'm going to save you 2 solid hours of navigating dense earnings call jargon and just give you the pure alpha you need.
Right out of the gate, these headline numbers are jaw-dropping. Nebius is completely rewriting expectations for the entire AI cloud industry. By the end of this explainer, you're going to have unique insight into exactly how they pulled off this hypergrowth, the hidden mechanics behind some massive new partnerships, and whether their aggressive capital expenditure strategy will actually crown them the undisputed king of AI infrastructure or just leave them totally overextended.
All right, so here's our roadmap for today. First, we'll break down that explosive growth and surging CapEx. Then, we'll look at their pricing power and those super deep ties with NVIDIA. After that, we're decoding the absolute masterstroke of the quarter, their mega contract with Meta. And finally, we'll pivot to the reality of their margins and the hidden expansion risks that could derail the whole thing.
Section 1, Explosive Growth and Surging CapEx. Let's get right into why Nebius is leaving legacy cloud providers completely in the dust. The sheer velocity of their core business is honestly incredible. We're looking at a monumental 50% jump in annualized run rate, just quarter over quarter. It shot from $1.25 billion up to $1.9 billion. And keep in mind, this core Nebius AI business makes up 98% of their total revenue. On top of that, their adjusted EBITDA margin for this segment exploded from 24% to 45% just by scaling up. This company is an absolute engine right now, fully backed by a record $2.3 billion in operating cash flow, which is largely driven by huge customer prepayments. So the really crucial question is, what's management going to do with all that cash and momentum? Well, they just drastically up-revised their 2026 capital expenditure guidance to between $20 and $25 billion. That is a massive number. And during the Q&A, management explicitly clarified that this unprecedented spending spree isn't because of component inflation. Actually, inflation only accounts for a low single-digit percentage increase since they locked in 2025 pricing early. No, this $25 billion is strictly to support enormous, rock-solid client commitments for 2027. They are literally building the future today. Section 2, NVIDIA ties and pricing power. Let's look under the hood at their business model and see how exactly they're securing these massive financial commitments. It really all boils down to their structural advantages. Nebius isn't just out there buying chips. They've actually secured NVIDIA Exemplar Cloud status for the GB300 training workloads. That is huge. It guarantees them priority supply for next-gen hardware like Vera CPUs and Rubin GPUs. And since their AI cloud pipeline grew by 3.5 times just this quarter, they're in a situation where more than 4 clients are competing for every single GPU they bring online. Plus, with strategic acquisitions like Tavily, EigenAI, and Clarify, they aren't just selling compute anymore. They're transforming into a full-stack AI native cloud provider. And because demand so vastly outstrips capacity right now, Nebius has absolute pricing power. They're successfully raising prices on both new and older generation GPUs. I mean, clients are just so desperate for compute that they are signing much longer contracts and handing over massive prepayments just to lock in future capacity. It's a total seller's market. Section 3, Decoding the Meta Contract. Now, this is the exact catalyst that is structurally changing the financial future of Nebius. Let's step through this brilliant 5-year contract structure, because honestly, it's pure genius. Step 1, Nebius secures $12 billion in dedicated compute directly for Meta. But step 2 is where the magic really happens. They set up a $15 billion capacity option. What that means is Nebius has the right to take that capacity and sell it at high spot market prices to other eager AI startups. But if the market softens, they can literally force Meta to buy it. This $15 billion option essentially turns Meta into a risk-free financial backstop for Nebius. Which leads us perfectly into step 3. By having tech giants like Meta and Microsoft on their books with these ironclad, backstopped contracts, Nebius can engage in highly favorable asset-backed financing. They are utilizing the mega-cap credit ratings of their biggest clients to secure the cheap leverage they need to fund that ambitious $25 billion capital expenditure plan we talked about earlier. It's just a beautifully engineered financial loop. Hey, real quick, if you want to stay updated on the latest US stock market news, make sure to subscribe to my channel. I upload new explainers every week. We dig right through the noise to bring you the exact mechanics driving the markets, just like this incredible Meta deal. Section 4, Margins and Expansion Risks. Look, unprecedented hypergrowth
always comes with immense execution risks. And as investors, we need to know exactly what the catch is.
Let's walk through this nonlinear timeline to prepare you for what management is calling a rocky Q2. In early 2025, they smartly locked in low component prices. However, in Q2 of 2026, you should expect a noticeable margin dip. Why? Because they're front-loading some heavy engineering, M&A, and marketing costs. The revenue from all this spending won't actually hit the books until their vast new capacity comes online, which is heavily concentrated in Q3 and Q4. And looking even further out, their colossal 1.2 gigawatt plant in Pennsylvania won't reach full load until 2030.
It's also super vital to understand their infrastructure strategy here. Nebius is targeting over 4 gigawatts of total contracted power, and they plan to self-own 75% of that infrastructure. Now, owning your own data centers, that's a massive competitive moat. But it requires intense, relentless capital burn and absolutely flawless construction execution. Any delay means billions of dollars just sitting there idle.
So, we have to face these harsh realities objectively. If those Q3 and Q4 capacity rollouts are delayed by even a few weeks, it's going to heavily pressure their short-term financials. Second, that brilliant financing strategy is currently over-reliant on just a few tech giant credit ratings. Third, and this is a growing issue across the US, they're facing local community and political pushback regarding their immense power consumption in states like Pennsylvania and Missouri. And finally, extreme capital burn means continuous fundraising. They recently raised over $6 billion and actually acknowledged they might need to tap into a 25 million share at the market equity plan. And yes, that could definitely dilute current shareholders.
Section 5. Key takeaways and next steps. All right, let's bring it all together and balance out the bullish engine against these bearish risks. The investment thesis here is a striking balancing act. On the bull side, the top-line growth, the absolute pricing power, and their strategic positioning with NVIDIA are just spectacular. And that Meta contract, an absolute masterclass in financial engineering. But on the bear side, this stock demands you stomach a tightrope walk. The extreme capital burn and that highly concentrated Q3 and Q4 execution timeline mean management literally cannot afford a single misstep in late 2026. It's the ultimate high-stakes, high-reward scenario. Now, I really want to hear your take on all this. Number 1, do you think Nebius can flawlessly execute their critical Q3 and Q4 capacity rollout, or will construction delays catch up to them? And number 2, which U.S. stock or company earnings should we break down next? Drop your thoughts in the comments below. I read every single one of them. Thanks for joining me on this explainer, and I'll catch you in the next one.